Welcome to the Dollar Debauchery program, brought to you by Cliff Cool's Notes, a daily consolidator on the most insightful presentations, articles, essays, and the interviews on the web on the ultimate confidence game, money. Our site presents ideas from the smartest and wisest money managers, economists, and analysts.
Hello and welcome to the Dollar Debauchery Show. My name is Danielle Park. I'm president of Venable Park Investment Council and the financial blog jugglingdynamite.com. I'm speaking today with Andrew Huszar. Andrew is a graduate of the Columbia University with a law degree and an MBA in corporate finance. His first job was in the legal department at the New York Fed, and he had a wide range of duties there in research, risk assessment, and policy initiatives. But in April of 2009, he was asked to help structure and oversee the $1.25 trillion mortgage-backed security purchasing program, which is the centerpiece of QE1 of the central bank. In November of 2013, nearly 3 years after he had left the Fed, Andrew penned an op-ed in the Wall Street Journal entitled Confessions of a Quantitative Easer, where he apologizes to America for his role in QE, which he says was the greatest backdoor bailout of Wall Street of all time. Hi, Andrew. Welcome to the show.
Hi, Danielle. Thanks for having me.
You know, one of the things, I read your article in November. I thought it was incredibly refreshing. I really loved the candor of it. But a question that came to mind, okay, you've left the Fed 3 years ago. You're now at the Rutgers School of Business. Why now, Andrew? Why did you feel now was the time to put those thoughts out there?
I think it really comes from the fact that, I worked in the financial sector, the U.S. financial sector, for 13 years before going into academia, and that was both on Wall Street. Most recently, I was the managing director at Morgan Stanley, as well as 9 years at the Fed. And even though I wrote a piece that was critical of the Fed, I do believe in the Fed, and I have a great deal of respect for the institution and for the people inside of it. And so it took me some time to make the decision to publicly air my reservations, and especially as things progressed, as QE has continued, and as I believe we've continued to go down a very bad path. In my mind, the desire to speak out and perhaps to start a conversation grew, and so that really was why I ultimately chose to wait. It took me some time to really get to a point where I felt compelled to speak up, and also I felt with the impending leadership change at the Fed from Chairman Bernanke to Chairman Yellen, I thought this was a good time in which potentially to draw attention to a conversation about what the Fed was really doing and whether it was helping.
So you were only involved in the first tranche of this, the initial one that began in, was it the fall of 2009, I guess, right? So were you, and then you complete that and you leave. Did you expect or understand at that point that they would just roll out the next version and the next version?
So in terms of my involvement, QE started on the day after Thanksgiving 2008. That's when it was announced. And the first tranche of QE involved $1.7 trillion of bond purchases by the Fed. I actually was recruited back to the Fed in April of 2009. I left the Fed after 7 years, and I was working on Wall Street when I was asked to come back in the midst of the financial crisis to run the program. And from April of 2009 until the end of QE1, I was doing the job that you had described at the beginning of the interview, and then afterwards was doing a bunch of the cleanup of the program. I personally thought that QE1 was gonna just be QE. We were gonna be QE1 and done, so to speak. I thought that in that the program had the goal the headline goal of the program was credit easing. In fact, when the program began, it was called credit easing, not quantitative easing. The idea was to make credit more accessible to the average American and to facilitate getting that credit into those Americans' hands because they were suffering from the financial crisis. And what we had seen during the program was that even though there was a lot of liquidity flowing into Wall Street and the Fed was pumping money into the financial sector, it really wasn't trickling down, so to speak, to the average American. So for me, it was a big. I anticipated that the Fed would learn, so to speak, from the experience, and for me, I left the Fed really when QE2 was announced, and that to me was when when it stopped making sense. I think it was very defensible to have done it to begin with, and we could talk more about that. But I believed at that point it stopped having real utility, or at least the costs far outweighed the benefits.
And did you have any, when you formed that opinion, was anyone around you of a similar opinion? I mean, I have not yet heard it expressed by Mr. Bernanke or any of the main officials that they don't think it's working. I mean, they've said that it's not a silver bullet or it's not a panacea, but they obviously must defend the policy to keep bringing out leg after leg of it.
So I think that's a really interesting point. I think if you really just pay attention to the way the Fed's talked about quantitative easing as it's evolved, I think there's some implicit implication that they realize that credit really QE hasn't worked in the way that the Fed anticipated. You have seen Chairman Bernanke give interviews in which he's talked a lot about how on the housing side, QE has been a disappointment in that it didn't really stimulate the housing lending that the Fed thought. But at the same time, and so when QE2 was announced, the Fed actually slightly changed the way it started talking about quantitative easing. It stopped being credit easing, so to speak, and the Fed started talking about the idea of a wealth effect. This idea that quantitative easing, rather than stabilizing the banks and hopefully thereby allowing for credit to be extended to Americans, the Fed started talking more about the idea that something called the portfolio balance theory, where the Fed was basically saying that in that it was buying a lot of the supply of private financial sector assets in the market, that was actually leaving fewer assets in the market for the remaining funds of investors, and that was because the Fed was changing the supply-demand dynamic in the market, so to speak. It was driving up financial prices, and so they started. The Fed started emphasizing the idea that because the stock market would go up in value, and because asset prices more generally would go up in value, that would actually mean that the well-off would have more cash in their hands, and they would hopefully consume more, and that would have this sort of trickle-down benefit. And so, I think it's there was a lot out in the public from the beginning about how QE wasn't really working in the way that it was anticipated, and I think the Fed, rather than saying it explicitly, has more or less started spinning the program in a different way.
So I have to ask you about that. The initial understanding, I thought, and maybe I was wrong, my initial understanding was that they meant to keep interest rates lower. Perhaps they weren't talking about interest rates. They were talking about liquidity and availability of credit, not specifically interest rates. Because the thing that I found quite interesting was that every time they rolled out the next round or next plan of QE, interest rates actually spiked each time, which seemed to me, was that a surprise to you in what you were doing, or to the people on the inside? They're buying up all these bonds supposedly to soak up supply. You'd think it would force rates down, but in fact we saw rates spike. Was that a surprise?
Well, and I think just to go back to sort of QE when it started, right? At the time, you had seen the Fed basically do about $1.5 trillion. So in the first phase of the financial crisis, Wall Street basically is on fire, right? And the Fed and the rest of the U.S. government does a number of measures through like TARP and all the Fed's financial stability programs to try to stabilize Wall Street. QE was the next step, right? It was this idea of because Wall Street was so impaired, trying to basically help buy some of the credit off of Wall Street's balance sheets and delever the banks. But also, it was very much to your point about lowering interest rates. The idea was the Fed had used up its traditional tools, which were really lowering short-term interest rates, and now it was using these bond purchases basically to drive up the price of longer-term bonds, like longer-dated treasuries and mortgage-backed securities. And hopefully by driving up the price, it was going to lower interest rates and make it cheaper to get a mortgage, or cheaper to borrow long term. And so, overall, there was a lot of volatility in rates over time, and I think it's taken some years for the market really to understand QE on some level. If you do look at the longer term picture, it has had some success in terms of driving down rates. Chairman Bernanke has suggested it's driven down the 10-year bond about 1.2%. Others would say between 0.6 and 2%. But there has been, longer term benefits. We have to remember you have had a huge crisis in Europe. You've had some other things that have caused. You've had optimism in the market periodically that have played with interest rates. But the real criticism I'd have is, even though rates have been somewhat impacted on the positive side, we haven't really seen the knock-on lending that the Fed has talked about. And so, if you look at lending since in the last 5 years, it has actually increased in fits and starts. And in fact, lending to the average American or to the average small business in America is actually at about an all-time low. The big banks are now devoting less of their businesses to consumer and small business lending than ever before. And if you look at this wealth effect that I spoke of earlier in terms of the stock market and asset prices going up, well, again, in the U.S., 90% of Americans own 10% of Americans own 90% of the stocks. And so, again, you've seen disproportionate benefits basically to the type of people who actually didn't really need the help. And so, people talk about QE and these central bank policies as pushing on a string. And I think that's a very accurate metaphor.
So I've heard you in other interviews talk about the benefits to Wall Street being in the hundreds of billions of dollars in various ways that they have profited primarily from trading, but also from commission structure in actually doing the bond buying and they were bought. The Fed was buying the bonds off the Wall Street banks. They were circulating the money through. It's been extremely lucrative, and bonuses have been off the charts again up until recently in that sector. Now, what would you assess or include when you talk about the costs, so that we know there's been this huge advantage to certain people? What would the costs, as you view them, be to Main Street?
So I think there's two main sets of costs, and I think the first cost, which is kind of a macro view, but one that I really motivated me to write the piece, is the idea that 5 years ago, or a little bit more than 5 years ago now, in the U.S., we had this relatively unprecedented financial crisis where we'd had 30 years of unchecked growth in the U.S. in the size of the U.S. banking sector. The Wall Street was twice as big as it had been in the 80s, and we had basically at the same time a decline in the economic situation of the average American, where more and more Americans were taking on credit to make ends meet. The average American was 3 times more indebted in 2008 than they had been 20 years earlier. And the financial crisis, there's a lot of explanations for why it happened, and I think a lot of them are viable. But on one level, very basically, it reflected the idea that the U.S. economy had got to a bad place in terms of its structure, and in terms of a too big Wall Street, and maybe an overly financialized economy where that wasn't really serving the needs of the average American. And so, for me, the biggest cost of QE is that it's fueled a sense of artificial complacency about where we are, where the U.S. economy is. If you look at the U.S. today, the banking sector is very much the same effectively. In fact, the six too big to fail banks in America are actually 37% bigger. And if you look at the average American, the median income in America just fell to the same level as it was in 1995 in terms of inflation adjusted. So I think there's a lot of structural issues in America that have not been resolved, and to me that's the biggest cost. The other set of costs I talk about are more distortions that have happened as a result of this unprecedented government stimulus program. This is the biggest financial markets intervention by any government ever in the history of the world. And so, if you look at prices in the financial markets, those prices are I believe distorted in that you've just had so much liquidity pumped into the market. And prices artificially stimulated. The Fed is buying still 70% of all Treasury issuance, 90% of all mortgage bond issuance in the United States. So a huge amount of public sector involvement in the markets. And you've seen a huge expansion in terms of the Fed and the Fed's involvement in the economy. The Fed 5 years ago had a balance sheet of $800 billion. Today it's over $4 trillion. It's 5 times bigger as an institution than it was 5 years ago. And the Fed will have to live with this legacy of its involvement indefinitely. We're seeing now, even this week, with emerging markets selling off because of the idea of the Fed pulling back its QE. There's whether it's inflation or whether it's the Fed ultimately generating losses, or there's a long list, but there's a lot of unintended consequences that have resulted from this program. And again, I believe that the benefits, if from a Fed perspective, within the Fed, I would have said let's weigh the costs versus the benefits. I believe the costs don't really justify what has been, unfortunately, not a great deal of benefit.
Don't you think, I have a legal background like yourself, and I think that in training in legal matters, you're taught about basic conflicts of interest as being a real red, a warning signal, something you must try and avoid and mitigate as much as possible. And it strikes me that the dual mandate given to the Federal Reserve, I think it was in the Fed Reserve Change Act of 1977, where they added the employment function. I think that sets people up for this push and pull between, on the one hand, price stability, where you need to be this kind of long-term mature influence that contains the credit expansion, because let's face it, everyone wants steroids when it's all going up, but then the system becomes impaired by the steroids at some point where there's just too much leverage. And isn't the employment mandate pulling at them, because that makes them this political animal, which they really ought not to be? When you have Chuck Schumer saying, get to work, Mr. Bernanke, surely that's a dark moment for anyone that's aware of the appearance of bias in these things.
Danielle, I think you nailed it. So I believe in the Fed, and I actually am a believer in government. I believe government does have a set of responsibilities that it needs to play in any economy, in any country. If you look at most any central bank around the world, and this is starting to change, but historically, they all pretty much have had one mandate, which is this idea of price stability, keeping the value of the domestic current stable. And ironically, in the 70s, as you mentioned, Congress introduced a second mandate for the Fed, which is that in the exercise of its interest rate management, the Fed needs to start worrying about whether it's going to be able to ensure jobs and employment. And ironically, at the time, you have to remember what was happening then. At the time, there was runaway inflation in the United States, and Congress was actually worried that the Fed was going to tighten and sort of raise interest rates, which is actually what happened when Chairman Volcker, who I think was a fantastic Fed chairman, what he did when he got into the office. But by raising interest rates at that time, it actually created more unemployment. But there was a longer strategic interest in ensuring in moderating inflation, and we saw a long-term growth pattern happen in the United States.
It actually required Volcker, though, to pick that long-term goal over the short-term goal, right? Like, you really cannot suck and blow both these things at the same time.
And part of that is that the tools that the Fed has at its disposal, they really don't work to do what people would hopefully want the Fed to do, which is to actually create employment. Interest rate policy has been proven to be a very ineffective policy, a sledgehammer for what really requires sort of tactical surgery. And if you look at the Fed, really, and I believe this started under Alan Greenspan's tenure, you started in the late 90s as you started seeing jobless recoveries in the United States, and you had seen this huge explosion in credit in the U.S. You saw the Fed begin to embrace activism and begin to embrace the idea that the Fed could actually use its interest rate policy not just to keep financial market conditions stable, but actually to promote credit creation. And you saw this in the late 90s when the Fed basically lowered interest rates aggressively when they're with the Asian financial crisis, with Y2K, with the dot bomb. And then you saw it in the mid-2000s when the Fed raised interest rates too slowly when there was this jobless recovery going on in the United States. And, lo and behold, from 1998 to 2007 in the United States, the amount of credit doubled during that period of time. And I'm not going to say that the Fed was the sole cause of the financial crisis, because I don't believe it. I believe there's a lot of Wall Street guilt here, and there's a lot of bad policies by the rest of the government. But this idea of Fed activism, unfortunately, is problematic in that, again, the Fed doesn't really have the tools to help, and often in trying to help, even if there's somewhat of a benefit to what it's doing, again, the costs usually outweigh those benefits substantially.
Now, there must typically be a tipping point, I think, in these long-term trends. So, for example, I agree with you. It's been, 30 years at least and longer of adding on leverage, taking away regulation, taking off the lines in the road between investment banking and the banking utility that's supported by the taxpayer. And so we've done a lot of things, and it hasn't been one or two. It's been a whole, series of events. But if we're going to put this genie back in the bottle, I look at things like the Dodd-Frank Act and the 2,000 pages, and it just doesn't get to the meat of it, which in my view is fairly simple. Do we not need to have just a basic division between the risk sellers and the bankers who are backed by the public purse? And if we do have that, wouldn't that just go a long way to correcting this? Because really, we're talking about human behavior. Again, if you're incented to add leverage and promote growth at all costs, you tend to do that at all costs. But if we're going to have meaningful controls or stability in the system, surely we need to have sort of a clear division between the regulatory arm and the risk selling arm, and even in terms of the revolving door between these divisions. Could we not put in place some rules that say, if you've been in policy, you can't go straight to Wall Street and vice versa? What do you think of those ideas?
I'm 100% in agreement with them. And if you look at Dodd-Frank, I think it's a pretty poor piece of legislation. I think it's overly convoluted, as you say, over 2,000 pages. It was passed in 2010. It's still about 50% implemented at this point. And really what happened was, in my opinion, is that Congress was at a place where it didn't really want to take some tough decisions, and so it created a bunch of flowery language that sounds fantastic, and then it left it to the regulators, the same regulators that had presided over a lot of bad behavior over a considerable amount of time, and then put it in their laps to try to come up with some rules. And what you see is the Volcker rule, right, which is a 900-page rule. People say 70 pages of rules, but there's 800 pages of interpretation, and it's full of holes. And so I'm a firm believer that in regulation, but I'm also a firm believer in smart regulation. And to me, smart regulation is simple, straightforward, and puts bright lines and guardrails around activity. And I mean, to be fair, people talk about the end of Glass-Steagall, and I think that was a huge watershed moment, because that really was when things took off in terms of seeing these mega banks being created and investment banking, commercial banking in the U.S. being tied together, and a lot of the funds commingling, so to speak, even if on the surface it didn't look like it as much. But the reality is, in the U.S., we've had a huge growth of banks, again, since the mid-1980s. And I think, for example, in 1987 in America, you had 87 banks controlling basically the equivalent of 30% of GDP of assets. In 2008, you had 6 banks controlling the equivalent of 60% of GDP of assets, which means that the banking sector in the U.S. became twice as big and roughly 15 times as concentrated in 20 years. And basically that's what we have today still, 5 years after the whole thing blew up.
Well, I was really happy to hear you say that, because my assessment of the risk and the leverage in the system is that we are almost exactly back where we were. In other words, we've spent $4 trillion in these various experiments, which may started out with the best of intentions, but the reality is we have not any lasting advantage from that. We've just got dead cash sitting on the sidelines. We've got some people extracting large bonuses, and we've got all the main issues still needing desperately funds.
I would argue probably, I mean, people argue this and I would accept it, that the banks are better capitalized on some level. You know, the QE in large part and some accounting tricks have generated huge profits for these banks. But let's be clear, these banks are huge, and their return on equity is very poor. These are very poorly managed companies. I mean, I was a managing director at Morgan Stanley. I can assure you, they've had 4 fixed income strategies in 4 years. I mean, you know, so and last year, if you look at their earnings, a lot of their earnings come from equities, and they've ridden the stock market ride like every other bank, and banks have really gotten a lot of juice out of these capital market gains. And the reality is, we have a banking sector in the U.S. where 6 banks control 2/3 of all the industry's assets, and that's you know, I believe in free markets, and to me that's not a free market where we have such control of the market by so few institutions. Institutions, by the way, which showed themselves to be mismanaged. We saw this through the crisis, and yet there's been relatively little accountability imposed upon them, and culturally, I'd argue, because they were so aggressively bailed out in so many different ways, culturally they haven't really learned their lesson, and that's something that I saw firsthand on Wall Street.
So you've have you got any blowback from, you know, your article, and have you muddied your opportunities in terms of going back to the Fed at some point? Would you go back to the Fed? You know, you went to Wall Street from the Fed. You're the classic example in some regards of, you know, using that time at the institution to go to the outside and be of great value to these institutions. How do you reconcile all that? What do you think about what you've done now versus how it'll impact you?
I'm glad you asked that, because some people have called me out for this idea of the fact that, you know, playing both sides of the fence, so to speak. You know, and the way that, first of all, I did leave the world of finance ultimately. My writing this op-ed and being so outspoken, I think definitively makes me a pretty poor hire, whether it's on Wall Street or at the Fed at this point. But I'm okay with that. This is you know, the path I chose, and I believe in the need for reform, and I also believe in the markets. I still believe in a capitalist financial markets system. I'm just trying to help make it better. But the reality is, you know, I am a finance guy. I did do a JD MBA at Columbia. I did work in the financial sector for many years, and so my going to Wall Street at some point was about continuing to practice the profession that I knew and knew. I was running a trading desk at Morgan Stanley that was implementing an important part of Dodd-Frank, which was the centralization of derivatives and implementation of the whole clearinghouse system, hopefully, which is going to happen. But the reality is, on some level, I also realized that, you know, culturally we have a larger problem, in particular in the U.S., which is an over-financialization of our economy. And I believe that we're at a point where our private sector, in terms of the big Wall Street banks, and our public sector, in terms of an overly deferential set of policies, are basically preventing the U.S. from moving forward in a positive way. I would suggest that what the Fed has done basically since the end of QE1 is basically the equivalent of if it was 100 years ago and the federal government was basically supporting stagecoaches against the attack of the automobile. I mean, I just think we are trying to put Humpty Dumpty back together again in terms of an economy that did expand for 30 years, but was proven to be very unstable. And rather than thinking about how we get our economy moving for the next 30 years, we seem to be just trying to put it back together again, because tactically it's an easier job than actually making some hard strategic decisions. And obviously, to be fair to the Fed, this is not the Fed's fault per se. The Fed, I believe, is compensating for the dysfunction in the rest of Washington. But in that it's being so aggressive, I think on some level it is somewhat complicit too in the dysfunction that's happening.
So I worry sometimes that, since I believe that you're correct, and perhaps they do acknowledge this and realize that it's not effective and that they really can't continue, with more and more and more. I'm worried that they don't have the independence, or they don't have the wherewithal to say to Congress, listen, over to you guys, enough of this, we tried, but we're really just aiding and abetting your bad behavior now and your ineffectiveness. I mean, at the end of the day, it's like when you have children and you keep extending credit. They don't learn good habits so long as there's more credit to be had, right? And this is, again, back to basic human nature. But do you have are you hopeful? Are you confident that the penny has dropped or will drop, or that they will reverse course or try and say, enough is enough?
Well, I'm not super hopeful, but I am ultimately an optimistic person. And one of the reasons I spoke out is because I hope to affect change in what's happening. But I think there's a couple of problems at this point. One is that we're seeing only more partisanship and dysfunction in Washington. And so, the window of opportunity to actually affect change is narrowing. I mean, at this point, the stock market, because of QE, in large part, is hovering at an all-time high. So it's really hard to make changes in a country when GDP looks better and the stock market looks better, and so it's actually benefiting a lot of the people in the country, and those people who have less of a say are really left out in the cold, but they have less of a say. But I also think, and I think 2014 may be the year. I do believe this will even out on some level, and there will be. Unfortunately, I believe this is going to be a really hard year for the Fed, because I think the Fed at some point is going to have to start living with the consequence of its actions. And I think this may be the year it does, in that they are talking about tapering. I think we're going to see a taper again at the end of January. That could be off the table given what's happening in the market, but I still believe that they're going to try to do it. And then, there's going to be a new chairperson in Chairperson Yellen, and I believe she's an incredibly smart and talented person. I only met her once when I gave a speech that she attended at the San Francisco Fed a few years ago, but I was very impressed with her personally. But I think she has probably the hardest job of any person in the world over the next year or multiple years in terms of having to pull back on this stimulus. And I fear that the Fed won't pull back, and I fear that, because the reality is, in pulling back, and we're seeing this again with the emerging markets this week, there's going to be potentially some massive volatility in the markets from that adjustment period, and it's going to take a really strong will in order to pull back on the stimulus. And I'm not suggesting that Chairperson Yellen doesn't have it, but I also think that's going to be a really hard act to pull off when the underlying economy and the employment picture is still actually pretty poor in the U.S. and the average American is suffering. So after QE1 ended, we saw a 14% in the 14% drop in the U.S. stock market, and that was $2.5 trillion of bond purchases ago. So I worry very much about the dance, and I also that the Fed is going to have to do, and I also worry about this tool becoming institutionalized. And even if the Fed does pull back today, whether the next time we have problems, people aren't going to want the Fed to crank up the QE machine again. And there's a lot of I have got you to go back to your earlier question. I have gotten blowback when I went on all these shows, and the blowback I basically got revealed a lot of complacency about how can you be complaining when you look at the markets and they're humming along. And I think that just reveals an unhealthy, I think, addiction to these policies, and I think again we're missing the boat and we're kicking the can down the road in terms of what we really need to be doing in the U.S. and potentially globally.
Well, the other thing it strikes me is 15 years in now, we've had these two, bubbly peaks in stocks where we saw a 50% collapse twice. And the Fed was fully involved trying to do everything they could throughout both of those cycles. So whether they taper or not, I think it's foolish to believe, since, as you're saying, it hasn't really worked. Really what we've had is had a belief phase where, sentiment's been buoyed by an assumption that they were having an impact. So once the realization hits that, hey, they can't really hold up these multi-trillion-dollar, global markets, then surely we get into another major crisis phase, which ultimately is probably good because it hopefully will force some actual, change in policy and more creative thinking. But on the other hand, don't you think whether they taper or not, they're at risk of losing credibility and people saying, hey, you're not the all-powerful wizard, and having a big correction in asset markets, which again will go back to, revealing the truth, which is that the economy is undersaved and there's not enough investment going into the things that matter.
Yeah, I mean, if you look at the U.S., so I have a couple points there. One is it's a very interesting moment because Chairman Bernanke is about to step out, right? And so, and he's getting a lot of praise. And I think on some level you have to give him credit for being entrepreneurial, particularly in 2008 when the Fed did a lot to stabilize the U.S. financial sector, and I believe almost every big bank was going to go under without the Fed's intervention. But I also think he's going to get, I think in the long term, he may get a lot more criticism, similar to what we've seen in the years after Alan Greenspan left. And when he originally left, there was also celebration, and he's been that image has changed over time. And I think he may actually, Chairman Bernanke may get some criticism for not, as he already has, not really understanding how over-leveraged and invested in housing the banks were before the crisis, and then for trying us, because he was potentially so scarred from his research about the Depression, overdoing it in terms of trying to use Fed tools to stabilize the economy in a way that not only haven't worked, but ultimately have potentially undermined or squandered a more significant opportunity to learn from the crisis and to reposition the U.S. economy. If you look at the U.S. economy, for example, structurally, it is in decline. Larry Summers talks about secular stagnation these days, and the idea that the economy, PIMCO's talked about the new normal, so there's this idea that the economy may be chronically underperforming. And if you look at it, what I focus on is the underlying conditions for growth. If you look at the U.S. 40 years ago, the U.S. was number 1 in college graduates. Today it's 14th. If you look at the U.S. A little more than 10 years ago, we were second in the world in infrastructure. Today we're 14th. If you look at us in terms of our competitiveness, when the crisis hit, we were first in the world in global competitiveness as an economy, and that takes into account infrastructure, but also our tax code, our regulatory code, and sort of what actually sort of stimulates entrepreneurialism. Today, the U.S. is 5th according to the World Economic Forum. So I think we're not making the investments, and we're not being strategic about what the economy needs to do. And you can only keep on pumping easy money into the economy for so long because the average American remains tapped out. The average American is maybe, as they say, about 15% less indebted than they were 5 years ago. There has been some deleveraging, but they're still 250% more indebted than they were 15 to 20 years ago. So, and they're not earning. Their earning power is decreasing. Every year, basically, relative if you take into account inflation. So, we have long-term issues, and I think ultimately, Chairman Bernanke's legacy may be that he took some tactical moves that helped, but he only impeded a larger adjustment that needed to happen in the U.S. economy, and for that reason, we may see more financial crises in the future.
And so what's for you next? What are you doing at Rutgers? Are you writing a book on all this? What do you see as your future step?
I basically am a senior fellow at Rutgers Business School, so I do lecturing there, and I do a lot of mentoring students about careers in finance. I actually have a consulting practice. I do a lot of small business consulting. Basically, in my career, a lot of what I've done is run businesses, so it translates well to the consulting practice that I have. In terms of a book or something like that, I'm still thinking about it. I very much would like to kind of give the whole picture, but you know, it's a really matter of figuring out if that's in the cards for now, or whether I'll just keep on speaking out like I am. And I obviously have a Twitter account, like everyone does these days, at Andrew Huszar. But still figuring it out, and really, this was obviously a huge fork in the road for me. It took a lot for me to make the decision to speak out. I've really been very grateful for the response I've gotten, but I also have to figure out next steps, so to speak. So I have my own crossroads that I'm going through right now.
Well, I have this belief that we will probably be talking about this phase and what went on in these years for the rest of our working lives, and we'll be telling our grandchildren about it someday. And thank goodness we have a few clear-minded folks who've been on the inside and have the courage and the clarity of thought to come out and inform and you know, educate the rest of the people who are just not aware of how everything's working. So thanks so much for your work. Keep up the effort, and we'll talk to you again.
Thank you very much, Danielle. Thanks for everyone listening in.